Hello everyone, how's everyone doing? Hope everyone's having a good Friday. Today we're going to be doing a market review, and I think I'll be starting a playlist similar to ICT's one, this 2025 lecture series, where you reviews just days of price action in general. And I think it would be great help for me to be able to kind of organize my ideas more properly, and it would definitely help me have a video log market reviews because if you guys have been watching my older videos, you know that I use Notion to log my trading days. And I think it's easier and I'm able to get ideas out easier and clearer through the user videos. And obviously, information should not be considered as an offer or enticement to buy, sell, or trade. Today we're going to be reviewing May 2nd, 2025. Here we have the daily chart of the Union Nasdaq futures, June 2025 contract, and the latest candlestick that has fully closed is the May 2nd candlestick. So a couple of levels that I have drawn out will play importance in the more micro scale intraday price action. More specifically, this premium wick low, the second available candle here. This candle here, I have the midpoint, which is the consequent encroachment, graded out here, which is around 1983 even. The high. This is also intermediate term high buy side liquidity. But I do not want to fit all that text onto this side because that will just make everything look very messy. So I just have it denoted as premium wick high, 2nd of April 2025. We also have the premium wick consequent encroachment, which as you can see price beautifully touches that and then begins to trade lower. And this daily volume imbalance, which is the gap in price where the wicks of the candle, the discount wick here and the premium wick here overlap each other, giving us a volume imbalance. So really quickly, before we move into the lower time frames, let's do a quick recap on the entire week. So as the week opened, we started trading to this SIBI, sell side inefficiency, buy side imbalance. And we found some stagnation within the first 3 days. But Thursday, where we had, it's obviously non-farm payroll week. Sorry, not Thursday, Wednesday, May 1st. We saw that price quickly had a big tail lower or wick that manipulated the entire day's sell side liquidity. And ICT actually mentioned that this would be an important objective for price, since it would enable price to use the gunpowder from running these sell stops to be able to deliver towards higher price action. And if you guys are familiar with ICT concepts, then you would have been able to pretty easily come up with the idea that the drawn liquidity for the week would probably be this high here. And the use of this BISI, buy side imbalance, sell side inefficiency, it helped price kind of gather the sell stops that were here and use the help of this discount array to take price high. Using that information, we came up with draws for the week by just having a level of kind of a hierarchy of arrays that would be met before the final one, which is the premium with consequent encroachment, would be met. So in that way, we came up with the low of this wick here, the consequent encroachment of the wick, and I don't have it drawn on it now, but the consequent encroachment level, or the mean threshold level of from this low to this high, as this is a propulsion block, and this was used once to take price lower, and we see how price broke down, then began to trade back higher using this breaker high and this liquidity void here, running price higher, back up and through it. And when I saw that price kind of had the idea of, okay, we're going to be switching order flow after taking these vertical highs, that kind of reassures me in a way that the next time that we do revisit this price region here, no matter if it's the consequent encroachment or the lower quadrants, it's probably not going to have the best respect for it as it did previously, as these are relative equal highs, and obviously these have breakout artists or pending buy orders at the high. And as you can see, as price takes that, it spends time accumulating orders. You see how there's a couple of candles that lie above this high here, and then we have Wednesday that drops down really quickly, scares the pending buys that were triggered here out by tapping into this VC, and then from there starts to return higher, and slowly it cuts through and closes through this propulsion block here. Through that, we were able to denote the high of this wick through the disrespect of the propulsion block and also the run through of these typical highs. I noted down actually that if we were to reverse from the relative equal highs, then intermediate term high and daily volume imbalance is likely not to be seen, as this run higher would just be a turtle soup that would bring us lower in the future. And it's nice to see how the opposite of that actually played out, which gave me a bigger picture and enabled me to come up with the high of this candle here as a future draw further and ahead of expecting spin or consequent encroachment. Moving into a more micro scale chart, the 1 hour. I just have a really quick note that I want to drop in that is important for all references. And this is also taught on ICT's channel. If you find more comfort in learning information from him than you do from me, maybe because of his way of teaching, you would most definitely learn what I'm about to mention in his videos. Anyway, usually when we're expecting price to gravitate towards premium arrays, such as buy-side liquidity or imbalances that have yet to be filled, usually on an intraday basis, what would happen is London sell-side liquidity would be used as a point of manipulation for price to run first and then start to gravitate towards the draws on liquidity. And as you can see here, London sell-side liquidity, which is the 3 a.m. low, was formed. You can see it's a swing low patterns where the previous candle's low is higher than the second candle's low, and the third candle's low is also higher than the third candle's low. That gives us a swing low that we can denote as sell-side liquidity. Obviously, we have midnight open drawn out, because it's a very vital opening. And from there, you can see that price runs down at 9 a.m., takes London sell-side liquidity, and that's our manipulation for the day. Again, when price is bullish, it tends to use London low as a point of manipulation to run pending stops, or sorry, pending sell orders, and then from there it would run high. And you can flip this around as well and say that when price is bearish, price will usually refer to London high as a point of manipulation and trigger pending buy orders and take out sell stops at that level, and then begin to just basically move up. That is clearly what happened in this scenario. So just a quick note, that would be good for context as we move to lower time frames. Moving to the really micro time frames, where most of your trades would be taking place if you were a intraday trader or scalper. We are now on the 1 minute time frame. So today, or on May 2nd, we had 830 unemployment claims, and we also had 10 a.m. ISM news, if I recall correctly. If I am misstating that, then you can check any reputable economic calendar, Works Factory. That's probably my best pick, and it would tell you the news that we had on in a second, and more specifically the high impact news. So breaking down the morning session or the opening range more specifically comes down to the use of the first presentation gap, and as we mentioned previously, the London low sell-side liquidity, which is in this case the point of manipulation. So instead of me saying London low sell-side liquidity as a point of integrity in the opening range, I would say it is actually the point of manipulation, whatever it may be. If it is an array, if it is a say opening range gap, well, those are all arrays. I said that it must be arrays in both cases. Anyway, we can see that as 9:30 opens up at around this candle here, you can see that it forms a candle that ran higher, fills this fair value gap, fails to touch the rejection block, but from there starts to displacingly move lower. This price rallies higher once more, creates this big wick here, price breaks down once more, one more rally, touching the consequent encroachment of this wick, which is the midpoint. Then from there it runs lower, giving us our first presentation gap. From there, we can see that price runs London low sell-side liquidity. After this point, you should be considering that the first presentation gap getting inversed after a point of manipulation that we just had, which is running London low sell-side liquidity. You can start to expect that price will start to deliver discount or premium arrays. And in this case, we see that price trades through it after running the sell-side liquidity, and notice how the body stayed in respect of the low. After that, we inverse the first presentation, reclaim it, and we kind of inverse its effects. Or I don't know why I said reclaim. We just inverse it. We inverse the first presentation gap, and then from there, we use it as support to run higher, and then we come in contact with a high that is created previously in the day at around 8:35 to 8:40 a.m. We reach higher, create equal highs, buy side liquidity with it. People who had their sell pending orders on top of this high are now triggered into support and resistance shorts. And obviously, price gets sent down lower. We reclaim the first presentation gap, giving it its purpose as a bearish fair value gap again. From there, we deliver lower and touch into a 15-minute order block. Now, what this creates is a second stage manipulation scenario where we have a short-term low placed in, we have a rally higher. Now, think about it like this. With this run lower here, it's obvious and it's evident that said orders were accumulated within this run lower, especially with the big use of the wicks and how it really took its time and spending its time down here, how it took the London sell-side low, the London low sell-side liquidity. So it's pretty obvious and it's safe to assume that there were sell orders that were accumulated within this run lower. Now the job of the first run higher, which generated more buy side liquidity here, is to take out the buy side that was accumulated on top of these highs. Now obviously when the people are going short in this run lower, their set stops would be on this high, and this high, and that's because they're swing highs. So we have set stops or buy side liquidity resting on these highs here. And this price has that first run higher, which in a break you see this as a low high. The high has a job of taking out the liquidity here and generating even more buy-side liquidity within the run higher, and also generates more buy-side liquidity within the creation of equal highs. So now there are even more buy stops on top of this high, or sorry, not buy stops, sell stops. More sell stops on top of this high and on top of this high. From there, price breaks down lower, and that gives us the lower low, which has the job of taking out the sell orders that were accumulated beneath the swing low, the swing low, and the swing low, and price does that perfectly. In the process, reclaiming the first presentation gap, and also touching into an order block. As we take this low, as I just mentioned, we run sell side. This is the secondary manipulation. Why didn't price start to rally through the run on the London no sell side liquidity? Why did I have to reach in there a second time? Now, the answer is the algorithm doesn't know how much orders they are under lows and highs. What it does know is people's tendencies. It knows that once we form a low here, it will have pending sell orders. And its job is to trigger these pending sell orders and then start to trade away from them to accumulate orders for smart money to be able to buy. And as you can see, as they buy, the sell orders here, people that sell here, smart money buys their stops, and then the algorithm sends it trading higher, placing smart money to profit. Through that, we can see that the order block here was triggered, and then as price starts to trade higher, it reclaims the first presentation gap again, uses its consequent encroachment perfectly to send price higher. As we return to it once more, notice the body's respect to the first presentation gap. As the wicks dig in, the bodies refuse to trade within it. From there, we see that price trades through mid and open, and then hunts the equal highs by side liquidity. Keep in mind, this high, this low, this first presentation gap is not to be ignored. Just because we use it once does not mean that we completely ignore it the next time the price revisits it. It will help to keep these levels on your chart. In my opinion, and this is purely my opinion, and you could have caught a winning trade going short or long within this day, depending on however you trade. But in my opinion, the safest and the most low risk was buying today. And the perfect opportunity showed itself as we breached the consequent approachment midpoint level of this first presentation gap. Price digs into it once, twice, and then completely leaves it. There, in my opinion, that would be the perfect area to go long and take your profits at the equal highs by side liquidity. Within this run higher, you will have ability to trail and to add on with a touch of this box wick and the engulfing of this move lower here, which gives us a change in state of delivery. It's also important to consider the regular trading hours, and you can see that within that move lower, we also triggered the half point of the opening range gap, which is the gap that happens with the price difference from 4:30 p.m. the previous day and 9:30 a.m. in the morning on the following day. You can see you can measure this level here with a Gann box or a Fibonacci retracement. You can denote the half point You can see how price digs into this once, twice, reaches into the order block, which is kind of a projection of how far price can dig in and through the midpoint. And if it does reach this much further, it's completely valid. It's okay. It's allowed to do that because it has a kind of resting net. It has a net that it can fall into and still be able to return higher without neglecting the fact that we did breach through the consequent encroachment. And this is also leading out the fact that the bodies did not come close to closing within the half point. Returning back to our ETH chart, we're going to be now moving in time, and it's important to keep reference on the drawings that I have dragged out to the right side of the chart, and you'll be able to refer to them as we move further in time. Following that, you can see that price continued to trade higher consistently. Runs higher here, immediate rebalance above the equal highs buy side liquidity. Goes below one time, rushes through it. Note how this candle first to that high, so straight higher, fair value gap. Order block here is held, taking price higher, and this is where we reach the premium wick. This is the buy side liquidity of the intermediate high. Rewind to the beginning of the video and you will know what I'm talking about when I'm referring to the premium wick high of 2nd of April 2025. This is a integral point of buy side liquidity. This can reflect if we are going to reverse or shift through this wick high. And this is the point where I would generally lose interest in trying to look for a trading. This is where I would sit back, look at what price is doing, and review it, and make sure that my analysis lines up with what price is showing. This price takes a intermediate high. It's obvious and it's important to recognize that two scenarios are able to happen. You can either shift through that high, and you can either totally soup the high and begin to move lower. This scenario, it's clear that price went through the high, spent some time trading in and through the daily volume imbalance, touching a premium wick, consequent encroachment level, 27th of March 2025. So moving a bit backwards in time, once, twice. From there, price runs lower, starts to use the higher daily volume imbalances resistance, bringing price lower. You see that we have a situation where we refer back to the premium wick high, bounce off it once, twice, and then as we return back to it again, price starts to use it again as resistance. You see how it flips its kind of roll. It flips its roll from using it as support to resistance here, and there price starts to get down higher, and then slightly lower. Go through the equal highs by side liquidity, back to the net open, refer to the first position gap again, hit the consequent encroachment level, run back higher, touch back the equal highs, and lower again. Touch the first position once, twice, 3 times, forming 3 swing lows at the level. Notice the respect of the lower bound of the first presentation gap. Run higher again, fair value gap, and that open. Value up higher again. Touch back into this fair value gap here, as well as run this intermediate term high. As we just mentioned right now, usually when we take intermediate term highs, either we reverse or shift from it. In this scenario, you can see that we shift from it. But in this case, where we have a high, low, or high, we fail to make it over low. This gives us this move higher here, is a mitigation block where price then trades away from. Then we just kind of try to bounce around the equal highs by side liquidity. And we return back to the net open, fair value gap, and the following slide continues. Following that, we see that price runs back higher and then starts to use the equal highs is kind of a point of consolidation. So it returns to it once, twice, and then just keeps referring to it until we near out into the final hour, and then price just begins to really distribute lower and close off where it has always wanted to close off. One thing that I want to take attention to is how we refer back to the daily volume imbalance as well as the premium wick high. Notice how we respect it perfectly here. That is very signature. We return lower from there. We fill a liquidity void here. And then from there, price returns back to it once more. So to trade lower, breaking down, consolidating around this area. And then from there, we fetch the first presentation. We run back out one more time, open that open, through it, and we reclaim it again as a SIBI. We run through and below the London low sell side liquidity. Return back higher, fade, touch the first presentation gap, but also fill in this SIBI. And then we get this one big spacing candle that takes us back towards the premium wick concept of encroachment, which we have not been at generally all day. And then from there we accumulate until we close off today, and then after the candle, after this we create a new day opening gap. Thank you everyone for watching. If you enjoyed this video and you want me to continue making more market reviews, please ask me to do so, and I will try my best to fulfill that goal. Hope everyone learned something new. This also helps me recap days and gather as much information as I can into a short form video instead of writing out pages of notes on my Notion journal. And this is a great way for me just to recap days. I can make this into a playlist, it's just market reviews, or I can make this into a thing where I do it a couple of times every week, or a couple of times every weeks, just on days where I feel that it's important to recap. Thank you all for watching, and more winning. Be safe.